Welcome to Pro News Weekly. Let's dive into the weekly updates on the financial markets. The US dollar continues to strengthen. Since the beginning of the week, the dollar index has gained just over 1.5%. However, the momentum behind this move deserves attention. From the lows at the end of September, the dollar index has risen almost 7%, taking it straight from the bottom of the trading range of the last 2 years to the top. Now, all eyes are on whether the bullish move will continue at the key resistance level of the last 2 years. The next move will be decisive. The main driver of the dollar rally has been the dramatic change in the U.S. political landscape, first anticipated and then confirmed in early November. Expectations of higher tariffs on U.S. imports are strengthening the dollar, as is speculation about tax cuts and deregulation. At the same time, the latter is supporting equity indices, although they are finding it increasingly difficult to rise in an environment of a strengthening local currency. Macroeconomics and monetary policy have temporarily taken a back seat, but should not be overlooked. The General Consumer Price Index rose by 0.2% for the fourth month in a row, and annual inflation increased from 2.4% to 2.6%. The core CPI, which excludes food and energy, maintained its 3.3% pace. This is above the Fed's 2% target, but is unlikely to prevent a December Fed's rate cut, which is now at a range of 4.50 to 4.75%, is well above inflation and is holding back the economy. The British pound fell below 1.270, hitting lows not seen since early August. In the process, it fell below its 200-day moving average. More importantly, it fell below the 50 and 200-week moving averages. Over the past 10 years, there have been 6 dips below this curve, with an average momentum decline of 14%. On the technical side, the path to 1.2000 is now open, despite the accumulated oversold condition. Whether the pound will go all the way depends on the balance of power in the UK and US economies and the actions of the central banks. In the short term, there is little hope for the pound against a backdrop of rising unemployment and slowing wage growth. In both cases, we are talking about normalization, not collapse. It will, however, allow the Bank of England to accelerate interest rate cuts. The single currency has been actively sold off since the US election, as expectations of new tariff wars coincided with the collapse of the German coalition and floods in Spain, not to mention ongoing concerns about the region's industrial sector. As a result, EUR/USD has touched 1.05. This is the lower boundary of the trading range since the beginning of the year. Historically, the 1.05 area has been a turning point for EUR/USD. A failure below this level paved the way for a rapid decline below parity. In 2022, the decline stopped at 0.95. In 2000, the collapse of the then-new single currency was halted by ECB intervention on dips below 0.85. The US S&P 500 hovered near the 6,000 level, marking a new psychologically important level. Market momentum needed to be clearer in the second half of the week. This was due to both fatigue from the 5% rally from the lows of November 4th and the steady appreciation of the dollar. Our attention is also drawn to the 20% fall in the Hang Seng Index from its early October peak. Technically, this is the start of a bear market, with a 6th week of declines. Trading in Chinese equities is breaking records as investors have conflicting views on the market outlook. Many say the stimulus announced is insufficient, while others fear a trade war. Only 15% of the 40% gain since the September lows, when the rally began, has been retraced, and that's still more than 30% from the lows at the start of the year. Investors have been taking profits in gold since the end of October, causing the price to fall almost daily. This week's decline is approaching 5%, with losses now more than $250 since the peak. And don't say we didn't warn of overbought conditions here before. Gold has rallied so much since last October that even a pullback to $2,400 would only be a retracement, taking the price back to the 200-day moving average. At the rate it is falling, it could be there before the end of the year. Cryptocurrencies continued to surge, pushing the total capitalization of this market to a new high of $3 trillion. It was just $2.2 trillion on November 5th. In other words, over 10 days, the increase was more than 35%. Bitcoin has gained nearly 20% since the start of the week, barely slowing at the 80,000 mark. It wasn't until it approached 90,000 that we saw any significant shakeout of positions. On Wednesday, Bitcoin stormed to 93,000, but after 4 hours, it was at 88. We also saw a similar intraday range of over 5% on Tuesday. At these levels, more and more crypto enthusiasts are switching to looking for interesting altcoins as they lock in profits in the first cryptocurrency. The easiest choice is Dogecoin, which has gained over 200% from the lows of November 3rd to the present. Given Bitcoin's 60% share of the total crypto market capitalization, which we last saw in 2021, the altcoin season has yet to begin. Next week, more countries will release their estimates for October consumer inflation. Canada will do so on Tuesday. The pace of price increases here is below the 2% target, allowing the Bank of Canada to cut interest rates by 50 basis points at the end of October. But how will the economy react to the 4% drop in the Canadian dollar against the US dollar since the beginning of October? With USD CAD reaching 1.40, its highest level since 2020, traders will also be keeping a close eye on inflation data. The UK will release its inflation figures on Wednesday. Here, headline inflation is well below 2%, with core inflation, which excludes food and energy, hovering between 3.2 to 3.5% and 3.5% for the past 5 months. This is despite the negative annual rate of producer prices due to the impact of services prices. The Japanese inflation estimate will be released on November 22nd, which may also play a key role in the future dynamics of the yen and the Bank of Japan's sentiment. In the European session, all eyes will be on the flash business activity sentiment for November. The release of the PMI indices often causes volatility in the euro, and this time, it may determine the fate of the single currency for the next month. Stay tuned to Pro News Weekly for more updates on global markets. Like, share, and subscribe.